Good. So again, welcome to today's free webinar, Your Money, Your Power. My name is Linda Makatiani, and I will be taking you through this session today. I'm the founder of Finance for Families. I say I am a wealth architect, and basically for me, what that means is being able to work with individuals, with couples, with families, in trying to realize, to move the financial vision that they have for themselves or for their families into a structured plan, which is basically what an architect does. And this is because I believe we all have this vision of where we want to be financially. And sometimes you just need that guidance and support in being able to achieve that. And I step into that gap to fill it, to provide you with simplified information on how you can be able to understand your finances better, to be able to just walk you through what is the options that are available, and work with you in building what we call, an optimized allocation portfolio, where now, we are looking at what you have, where you are, where you want to go, that vision, and then translating it into a portfolio that is, optimized to be able to help you realize that. And once in a while, I do this free webinars. April is Financial Literacy Month. So I said I would not want the month to end before I'm able to just share a few things here and there that I have seen, and I have been asked, I have experienced, because I have been in the capital markets, the Kenyan capital markets, for more than 15 years now, in corporate, and then I set out now to just be able to do it independently so that I can, curate that time to work with you and your partner and your families in that journey at your pace, at your level of understanding, and all that. So this is one of those sessions that I have. And I say today, let's look at money, because financial literacy is all about getting us to understand our personal finances. And at the core of our personal finances is money, because if you think about it, money affects every single aspect of our lives. So it's just good to know, as opposed to it controlling us, if we can be able to be the ones, sitting on the reins and saying, go this way, do this, be here for this long, and then after that, we will do 1, 2, 3 things. And how I structured the session is I had asked on my social media platforms for, any questions that people have, or any topics that they feel they would want more insights on, and then now I use that to be able to curate this session. So I will start us off by just an overview of the topics that most of the questions I got were on. One for me was on mindset, which is very important. So for me, when I do my coaching sessions, the one-on-one sessions, even before we start talking investing, for all my clients, whether it's an individual, if it's a couple, even the young ones, the ones, I call them young ones, the Gen Zs maybe who just started working, I find it very, very important to talk on mindset, how to cultivate a positive growth mindset. And another topic that I rarely hear it being discussed, but it's also very important, is on emotional intelligence. So for me, as part of the foundation, we will talk on mindset, and we talk on emotional intelligence as well. And then now that forms that strong foundation that all of us need to be able now to move on to the next, which now would be on understanding the options that are there. So we'll touch a bit on mindset. There was a question that I felt this would be a good one to tackle it from a mindset perspective. Then we also have questions just centering around funds, money market funds, the special funds right now, And we had a question on SACCOs as well. So we look at that just to get us to understand, with everything that is going on with SACCOs, should we still be putting our money in SACCOs? We're going to look a bit on investing when it comes to investing in bonds. What are some of those gems? Investing in stocks, what do we do, where, which ones, and all that. And then on generational wealth, we'll just be looking at retirement planning and legacy planning as well. I know sometimes when you think of generational wealth, we only think of it from a legacy perspective, but the retirement plan as well is part of your generational wealth, because you might put something together, but then when you get to retirement, if you had not planned for retirement, then this generational wealth that you are hoping to pass ends up being what is saving you in retirement. So then you end up having nothing to pass. So you really have to be able to look at it from a holistic point of view. And the reason why I said, your money, your power, is because the first bit in us being able to harness that power that is within the financial capability that we have is when we understand, how to be able to handle this money, how to be able to, put it in opportunities that are able to help us exercise the power that is within us, because we do have this power. It's just we need to be able to understand, so what are those opportunities that we can employ this money and harness the power that is within it. Yeah. So we start off with the mindset bit, and this was a question I had. So on my Instagram, I had shared, this was during Women's Month, and I had said, for me, there are certain funds that I feel every woman should have. And I had shared several, just have an emergency fund, you have an investing fund, there's the bit where, have your own fund, that one, my me fund, however you want to call it, name it, own it. That is part of ownership, also motivates you into being able to put. So that the name that you give your fund as a woman, as a man, should be something that reflects the goal for that fund. And one of the comments that I had received on that post was a lady who'd asked, so how do you appropriate money in all these funds? Do you have expenditure at all? You can just see you can feel the emotion in this. You have school fees, you have house bills, you have fuel, you have African tax. Because I find it hard to have a penny left after all the expenses, even to buy myself clothes. However much I budget for my income, most money goes to expenses, especially for children. Now, one of the reasons why I decided to put like a man's picture there is I was trying to imagine, like for a man, would they have the same kind of questions as my follower here? And I picked this as part of mindset because I wanted us now to look at it from this point of view, where our relationship with money really starts before even we start earning, before we make this budget that we are trying to fix everything in between. Now, a few days back, I did a podcast, and it was on women and wealth, which was also like another topic people had asked, but this is going to come out as a podcast. So I said, for that on women and wealth, I will wait up until the podcast is out. But one of the, I would say, the insights that I was sharing for me, and I'm sharing it as a woman and as a mother, is I can relate to what she's saying. But one of the key things why I put it under mindset is because when you start looking at it from a point of view of how am I ranking my priorities, and how much do I, again, feel that it is going to be enough for me to be able to cater for all these things and then have surplus, or to buy for myself something. And should what I'm using to buy myself something be surplus, or should it be as part of the budget? So, and as you can see, I think all this just goes back to our mindset, where we're able to look at all these things that we feel we are obligated to, and not really starting from that point of what are my values? What do I have to prioritize? And then now work with that down that list. Yeah. So of course, yes, there's the school fees, there's the bills, things that you have to pay for. But if you were very honest and you look at it from a point of view that up until I can change my income level, then I have to be able to work with what I have. So one, I need to develop that growth mindset, that I am going to be looking at it from that point of view of I have done my priority list, and I am looking to see what is it that I don't really need, and what is it that I want, but it can wait. Yeah. So there are things that you don't really need, but they are there. There are things that you want, but they can wait. So again, it's now looking at it from that point of view. And then two is now seeing what are those possibilities, opportunities that are there for me to be able to grow this pot so that I can accommodate more and more of the things that I want. Yeah. So it's not looking at it from a scarcity point of view, but it's looking at it from like, what can I be able to do so that I can be able to grow it? So when you develop that growth positive mindset, it takes you away from being being emotionally reactive, like and then you now start being very intentional about what you're doing with your finances, where it's going, and all that. And I can talk of it from just the point that all of us can relate, the African tax bit, where the emotional reactive bit would be if I get asked to be, to contribute something and all that, I would feel like I cannot, if I don't contribute, then it's going to weigh heavy on me. But I tell people sometimes we feel that because maybe you have money sitting somewhere, or you have money on your M-Pesa. If you assign your money a goal and it is working towards that goal, then, and you have done your priority list, and these are the things that I am contributing towards. If I'm able to help two people and a third person comes along and they have a need and all that, if I have already employed my money and I say I do not have anything right now to help, to offer, I can offer maybe my help in kind, be there with you as you're going through it, help with the visitors, all those things, you will feel way better than you have not really, one, maybe even budgeted, or two, you have money sitting on your M-Pesa, on your bank account, and you're saying no to helping someone. So I always say, be very intentional about where your money goes every other time. And it doesn't mean that when you're budgeting, you don't budget for that African tax. Have it as part of your budget so that you can be able to help, because social capital is very important. But what I'm trying to say is that mindset that, yes, I can be able to help, but I can't be able to help everyone. I have my priority list, because at the top of that list should be me. And the number one asset is myself. So it should be me and my priority needs. And then the ones which can wait, they can wait. But it's very good to be able to sit back and work on that. So for me, this was one of the questions I thought would be good to tackle, the mindset question about it. Yeah, so again, a few questions on budgeting, and sort of related to the first one as well, but that one I said I would do it as part of mindset change. But this one is, so how should I start managing my money? And I know basic would be if you Google or you go to any ChatGPT and all that, you'll be told, yeah, track your expenses, or write them down, all those things. But those, I'm sure for most of us, we've already had. So I wanted to share a few that I feel like we often overlook, or we don't really think of them that much. Yeah, and I think I've just touched on it lightly when we're talking about mindset and budgeting. One is your income should not be your budgeting starting point. Your values should be. So you have to first think about, what's the kind of life that I want to live? What matters most to me? And like, what's my vision for the next 5 years? And for me, these are things like when we are working out your investment roadmap, we look at that. So what is it you're trying towards, you're working towards for the next 5, for the next 10, for the next 15? Because then it's a building block. Yeah. And now we base it on that. So when someone, or even yourself, when you look at your budget, you should be looking at it and seeing your values reflected from it. Yeah. What do you value most? That should be part of your priority list. When you build your budget like that, it becomes self-motivating. But if it's more based on my income is this, so then that means 50% should be my expenses, 30% I'm supposed to put into my savings and investments, and then 20% are what I'm going to put into my wants and all that. That should not be cast in stone. Yes, you can use that as a guideline. Again, percentages are good, as we'll see. But it needs to start from a values proposition and not really the income bit. So that's one. The other one is, and these I've seen with a number of couples that I have, that I work with, that when you build a budget alone, it will be broken by someone else. So if you're in a committed relationship, and you're sharing expenses, if you're married and you have, children and all that, when you're making your budget within that unit, let it be a shared responsibility. Because most of the time, I think it's just one person who handles that. If it's the man will bring the money and expect the wife to be the one to sit and do the budget. But the decisions that this man makes out of the budget will come back to either harm or, put the family in some circumstances that, would have been avoided. So it's very good when both parties take ownership in that budget. And that's why I felt like this is one of those things where, yes, we can talk about tracking, the importance of tracking our numbers and all that. Yes, they're very important. But again, let us do it from that point of view where we are looking at all the people who are affected or need to be part of that conversation, and then include them in that conversation so that everyone takes ownership, we support one another, in being able to, just work through this budget, making changes. Again, budget is not fixed. It is should be a live document. So you should make it, and sometimes I say it's okay to look beyond 1 month, because 1 month would be a guide, but you don't pay school fees every month. There's some bills you do on an annual basis. So again, those are considerations. When you come together and sit, you're able to do that. So on budgeting, for me, those are two things that I thought are very key. You cannot start building wealth. You cannot start accounting for your numbers in the dark. So one, have that conversation with yourself and get to understand, what are my values? When you're doing it as a family, again, is to sit and be able to understand how to incorporate everyone's value within your budget system. And it starts with conversations. I will say, I think it's very important for us to be able to take a holiday together, and all that. My husband can say, okay, for me, I feel like it's very important that our kids get a very good education and, maybe a good Christian school. Then now we work around and see, okay, so where can we afford, put some money aside for, a good education, put some money aside for a good family holiday. So everyone's values gets incorporated in that. And so very important, first have it with yourself, and then now share it with the others that are likely to be affected by it. When we're also talking about budgeting, I felt this is very important, because sometimes, and it goes back to even the first question for, like, how do I even get money to set aside some money for saving and investing? And this is one thing that I always encourage everyone to look at your savings rate. And I want us to think of it from a point of view that it does not necessarily mean that, I have to have a very high income. That is how my savings rate is going to be the highest. And I thought, let's take an example of these two gentlemen. So we have Michael and we have Stephen. So both of them earn the same amount of money. They both earn, let's say, a net of 300,000. But Michael will only save 10% of that. So he's only going to be saving 30,000 on a monthly basis. But Stephen is very intentional. Again, we go back to where we were saying on the mindset bits. Yeah, being very strategic and intentional. And you work around your values, and you want, this is my vision, and I want to be able to finance that vision. What will it take for me to finance it? And you come and say, okay, mine, if I work with 35% of my income, then that is it. So he saves 35% of his income, same salary, everything. So in 5 years, at the same rate, even if they put it in the same instrument, meaning that the money that has been pulled there is being invested in the same instruments. So they are both earning at a 12% rate per annum. Michael will be at 2.7 million, but he's going to be at 9.7 million. So again, we see mindset and all that. It should not really, the concentration should really not be on how much, yeah. When you start it from a values perspective, then you put numbers on those values, and then you get that rate that will help you to get there, and then you get to those numbers. So this is just a guide again. So if you, and this is maybe homework now for all of us, yeah. From here, I would want us to go and see and just look at my salary and how much I've been managing. I'm saying managing because, we have so many other things that we're doing, but managing to be able to put aside for my savings and investing. What percentage is that? So if it's below 10%, just know we are like very many of us who are just one emergency away from debt. Yeah. Because whatever we are pulling aside is not enough to be able to just help us in case we have any emergency. If it is between 10 and 20, then yeah, it's very it's functional, it's okay, but sometimes, okay is not enough. We need to push ourselves just slightly more. So it's functional, yes, it's a good start, but again, it's to understand that it's slow. Need to pick up the pace a bit. Then if it's between 20 and 30, that's intentional. You are now more focused. You're working to build with purpose and all that. If it is above 40%, then now you're in wealth building mode, because then now you're putting in more into that pot that is not necessarily just for saving, but it can also now sufficiently go into investing. And investing is where now the real growth happens. When you start accounting for interest and compounding interest. So this is should be our first, I would say, assignment from today's webinar, where we are going and we are asking ourselves, how much have I been able to put aside? And where is it getting me? And why that? And then now go back and start from the angle of your values and see how do they correlate and all that. Yeah. Another one I asked, which is close, is on assets and liabilities. And I think this was more from an angle of, like debt and all that. So basic understanding is just assets is anything that puts money into your pocket or it grows in value over time. So if I ask you, so what are your assets? And you start naming, you say, okay, I have some stocks, or I have this property that, is bringing in some rental income, or I've invested in this business that is paying me a bit of money here now and then. So it could be like a side hustle and all that. if you think of liabilities and you're thinking of things that are taking money away from your pocket, so it is that loan that you took that really went into consumption, so but you still have to pay it. So the money that the repayment has to come out of your pocket. It's that maybe a really expensive car that you had decided, I need to buy this because now I got a promotion. How will people in my village know that, you know, I'm in Nairobi and now I'm not just a senior manager, I'm in Swiss level and all that stuff. And those lifestyle purchases, you know, always thinking people think of me by, you know, if I'm like this, I live in this the suburb area, or I'm driving this car, or my kids are going to this school, then it's a statement. And all that. Meanwhile, you know, you are struggling to be able to maintain that, because then you always it's always removing money from your pocket, but you know there's no value add to it. And then there's like a middle point for all of them, which for me, I feel like, yes, someone might be looking at it as a liability. You know, you can look and say, oh, why would they want to buy that car? Yeah, they have to pay car insurance, they have to fuel it and all that. But if that car is enabling me in my business to be able to deliver items on time, or, you know, be in places where I would likely not have been able to reach as fast. I was engaging with a lady who is a mobile masseuse, so she does massages, and she comes to your house. So for someone like that, if they were to put money and buy a car, and this car is helping them get to, you know, their clients, provide the service that she provides, and then she's able to earn from that, then that car is actually paying for itself. You know, you could look at it from a point of view where you are doing a professional course somewhere, and when you complete that course, you're able now to go and you know, negotiate for like a higher salary or something. So it will cost you, but it's also in the future, it is going to come back and be able to just repay. So it's looking at it from that angle as well. So it's not always either it's an asset, it's a liability. It's looking at it from that way. And businesses do this very well, where they are saying, we have this project we want to do, but you know, it will bring in money, but we don't have the money to put in right now. So they can come into the market and ask people to invest in that business. People give them the money. They will owe people that money, but through that project, they are able now to start bringing money in. So then it becomes a strategic, you know, asset liability project. So this, for me, I think was one key fundamental thing I wanted to be able to touch on, you know, when you're looking at assets and liabilities as a topic. The other question that I got was on SACCOs, and this was again just to, you know, from my followers to try and understand. So where does SACCO fall when you're thinking about savings? You know, the times of our parents and the older generations, SACCO really saved them. They were able to put money in SACCOs, go borrow, you know, fund, especially fund the education of their children, and all that. But now we, you know, we are this way. One, we have more sophisticated investment products. So we are looking, question then would be, do we really need to be members of a SACCO? And I would not say yes for all of us. Of course, again, it depends on, so for you, what is it you want to join the SACCO for what? So yes, there are people who would join and say, yeah, for me, I would want to go to diversify my dividend, my, you know, passive income streams, and this is one of the ways. So then you would be putting money there so that at least you can be able to receive the dividends. Of course, the more you have, the more you're getting from your SACCO. Then there's also the aspect where now you can be able to borrow if you're a member of a SACCO. I always say, if you're looking, especially on the loans bit, please just make sure you don't join alone. You join, if you belong to like an investment group, then it can be a joint discussion, and then you all join. So then now you are each other's accountability partner and each other's guarantors. It works better than, you know, trying to befriend people when you've joined to be able to guarantee you at that point where maybe you'd want to to take a loan. But I wanted to base this question and answer it from a perspective of what has recently been happening with the SACCOs. You know, we've been seeing a lot of bad, negative, let me say negative news coming our way when it comes to SACCO news, especially around governance. So I thought, even as you're thinking, do I join, you know, should I? Yes, maybe yes, we are a group and we think it's a good idea for all of us to join. It can help us, you know, to grow individually and support each other collectively within the SACCO. The other bits based on, you know, what has been happening recently is, one, whichever SACCO you're thinking of joining, please verify that it is SASTRA regulated. So just going on to sastra.go.ke. So if your SACCO is not listed there as a deposit-taking institution, yeah, that is the first warning sign. You know, ask those questions before you join the SACCO. Why is it not? You know, and all that stuff. And then it's also to ask so that you can be able to look at their financials, the audited financials. And for me, the key things I would say you look at is the default rate. Default rate is basically the SACCO. Yes, so we have very many of us would be joining for loans, but then this money that is being loaned to people is money that we are depositing into these SACCOs. So it's also in our interest to know how many members who've taken loans are not repaying. Yeah, so that default rate. So the higher the default rate, the more alarm bells should be ringing in your head. Then there's also the reserve ratio. This is like the money that the SACCO has in reserve to be able to absorb those shocks for, you know, people not paying, or maybe members panicking and coming to withdraw money in large numbers. So when you look at it, and also plus who the external auditors are, we don't really have to be like finance experts. But sometimes if you look and then you Google them to see, has there been news, negative news about those auditors? Again, I think that's one of the benefits of living in this digital space. There's a lot of information we can get by, you know, just saying, yeah, any bad news about, and then you search those auditors. So for me, these are key things, you know, above and beyond. Yes, why do I want to join the SACCO? Yes, if you do decide you want, please try and do it with other people who now you would be able to keep each other accountable and support each other within that SACCO system. And again, yes, you work on your contributions so that you higher your contributions, the higher dividends that you get. So it can make a significant dent on your passive income stream. Yeah, so for me, those would be the key insights on when it comes to your decision making around at this particular time. Can I go into SACCOs? The other very popular, of course, I think this is would be an echo for most of us, is on investments. And on investments, we were looking at, yeah, so just questions around investing in stocks, investing in bonds. Is it a good time to invest in bonds right now? Like property investments, you know, we need a lot of money. So do I have to wait until I have enough? Are there other options that I can be able to do to be able to have as part of my portfolio, even as I work towards buying that, you know, apartment or buying that land so I can build my my home and all that. And then the managed funds, you know, the money market funds that are, and the special funds, which have become very popular. Questions around those ones. So on the real estate one, I think the main question was just on really what other options are there, and what we have as options when it comes to investing in real estate is, one, either just investing in the physical product, which is buying that piece of land or buying that apartment, or now investing in companies that are in the real estate space. Then money is pooled. They would be able to take up those real estate projects, and on completion, and now maybe if it's an office block or an apartment block and it's rented out, that rental income is pooled and comes back to you in the form of dividends, depending on the number of units you have. So locally for retail, the most common one is through the VUCA platform, which the underlying is the Icon Investments, the company that is behind Kwetu Kejani, the student hostel housing accommodations. So with that one, again, if you want more information on how to start and all that, there's really, I would say not much in terms of a minimum, but at least the entry levels are affordable. So we can have that discussion. Just reach out to me and then I'll be able to take you through that. So it would be a good starting point for someone who would want real estate investment exposure on their portfolio before now they're able to buy property. Yeah. So then now we can look at the other options, the questions that came through on the other investments. And of course, the first one is shares. Love these discussions on shares. Yeah, and it is always, yes, how much do I need to be able to start investing in shares? Yes, should I invest? It's very volatile. People always saying I'm losing money. And then again, in a bit, you know, people come out and say, oh, I bought at this price and I sold here, I made, or you could have made this much, and all that. But for me, let's say, I feel like stocks are very simple. You know, we can all buy, because especially now, they reduced the minimum number of shares that you can buy. So now you can come in and buy as little as 1 share. So of course, I would not advocate for you to come in to buy 1 share, because remember, for every transaction, there are fees to it. And one of the things, of course, we have to look at is what is that, the net consideration. How much are we paying for these stocks that we are buying? So it's always good to pool money, and then now you can come in and buy. One of the strategies I use with my clients when it comes to investing in stocks is to be able to have like a dedicated fund just for investing. And this is where we will be pulling money on a monthly basis, or as frequently as now as agreed. And then now we look at the investment opportunities and take them. So we don't get into the situations where when a good opportunity comes is when we are looking for, oh, let me look for money here, or let me think about getting money this other place. No, we have that money pooled, parked somewhere, earning interest. And then now our decision making is just, okay, so this is the option, the investment opportunity that is there. We look at the project proposal. We see, yes, it's a good investment. You know, we work on the entry strategy, the exit strategy, and everything. And then you say, okay, fine, let's buy into it. And then now we are able to buy into it. So I do feel it is simple, but we're now getting to know, so what do I buy? Where do I buy? And that is not a question that I can easily answer in a forum like this one, to be honest, because we are all different. Some already have a portfolio, they have started building. Some maybe bought a few years back, they got disappointed when the market tanked a bit, and then, you know, they abandoned their portfolio. So it is a matter of now reactivating, looking to see what you already have, so that now we can just align it. Some very risk averse, so then we have to have that discussion to see, okay, then for you, these are maybe the stocks that we can be able to buy. So I always say, when I'm asked that question, I'm like, no, this requires a sit down so that we understand, because everyone's stocks portfolio is very different. It should reflect their personal goals and their risk tolerance, which is very, very important. We don't just work with, okay, let's just buy this, buy that. A professional would work with you that journey to understand what are you building the portfolio for and what is your risk tolerance through some tests. We do some very interesting ones with my clients as we try to understand their risk tolerance level, so that we can be able to put together the right kind of companies to invest in. Yeah, the other bit is just there. And that, as I was saying, this is the strategies where the real challenge is. When I cover emotional intelligence, it's mostly for the stock market, because you'll find most of the negative stories, sad stories that we hear about the stock market was not really about the market in itself. It was someone maybe who had gone into the market, but they had not taken time to understand how it works. and they had not taken time to grow their emotional intelligence when they are investing, especially in stocks, because of the volatility nature of it. So this is one of those things, you know, how do I manage my emotions? How do I understand my emotions and use it to my advantage instead of it, you know, now negatively affecting my stocks portfolio? So again, those are conversations we have when we do the sessions on investing in stocks. And it's one of those sessions where when I do it, I break it down for people, for clients who come specifically for stocks investing. I break it down into 2 sessions. We cannot cover everything in one and agree on what to buy and start buying and all that stuff. The foundational bit for investing in stocks is very different from the foundational bit of investing in bonds, or, you know, just deciding, putting together your savings strategy. Because of the volatility aspect of this asset class, I say it's very important to be able to do it in 2 sessions, and then also continuously do it through what I call our accountability sessions, where, you know, every month when you are coming in, or even in between when you are feeling like you want to start panicking over something, you know, we will sit back and talk through it and say, okay, the reason why we put here is because of this, and the price that we are targeting is because of this, and this is the data that is showing that it is likely to go there. So, you know, let us relax, or let us come in, it's come down, instead of panicking, let us buy some more, and all that. So those are some of the advantages you get when you are able to go through together during the stock session. So as I said, yes, very common questions is on that. Which stocks do I buy? This is just but half of the price list. So if you would want to invest in the stock market, on the Nairobi Securities Exchange website, they normally share this, and I don't know if you can be able to see. Maybe let me just try. So this is actually today's price list. So this is April 29th, which is today. So I try to make sure I get, and now we can just look at some of them. So some of the things that you can look at when it comes to investing in stocks, just a bit, would be, yeah, of course, which sector are you putting your money in, the companies in each sector. Diversification rules are, yes, please don't buy everything in just one sector. So someone would say, I will just buy banks because, you know, banks, they pay dividends twice a year, and I want to be able to get some dividend income. But they're in the same sector. So if anything was to happen across, you know, the finance space, then your portfolio is going to get 100% hit, as opposed to just trying to diversify. Yes, you can have some good stocks from the banking sector. You can look at the agricultural sector. You know, you can go look at manufacturing, look at energy, telecommunications, and all that. Then now you diversify. Again, the diversification bit is also a discussion that you have when we have when we're doing the portfolio building. But what I wanted to share here is just one, the liquidity aspect, which I think across board, even as you are thinking about diversifying across sectors, it's to just be able to track and see how liquid is it. Because at the end of the day, you're building a portfolio, you're putting your money here, you want it to grow. But you do want to get to a point where you can still be able to realize the profits. And I tell my clients, yes, we could be working on an accumulation strategy, but it does not mean that all we'll do is forever buy, buy, buy. If there comes an opportunity where we can see that this is a good exit point, we will realize the profits. And what I mean by that is, if we have bought, if we can just pick even ABSA, because I know ABSA is coming down. If we can pick one of these, yeah, so let's say, even if you look like maybe at ABSA, so ABSA, this is within a 1-year spread. So from last year to this year, it has moved from 15 shillings to 33 shillings. Something like equity has moved from 41 shillings to 80 bob. KCB as well, around the same, from 35 to 80.50. Standard Chartered from 260 to 370. I had a client of mine who highlighted this the other day for me. He's like, oh, remember we bought Stanbic at this levels, and now it's double the price. So if you look at that, this is an opportunity in itself. So one, again, part of your strategy should be when you're investing in stocks, it's active investing. You're not just buying and sitting and waiting for the dividends. It's always looking what other opportunities are there for me to make money. Yes, the dividends can come. But if you get an opportunity like this one, like, looking at Stanbic, you had bought, even if you say you had bought at 150 and it's at 300 shillings, you can come and realize that profit. Because if you do not realize that profit and now reinvest that profit into something else that also has a growth opportunity, the profit is just paper profit, meaning it's just there, you can celebrate it, but it's not really tangible. It has not helped your portfolio in any way apart from just on the portfolio valuation sheet. So it's very good to work with someone now who can be able to guide you through that and say, here I've seen there's an opportunity here, we have gotten good. It doesn't mean we are exiting, we are selling everything. It just means every time there's an opportunity, it goes up by, let's say, 50 bob or 100 shillings, we take 100 shillings off every share that we have bought, which sometimes you find if maybe you have 3,000 shares, you're only selling 1,000 shares, and then take now that profit and reinvest it into something else. And it could be now maybe you're even moving that money into something that is less volatile. So it could be we have put money in stocks, we bought Stanbic, it's made us good money, we realize that profit and we take that profit and go and invest in a bond. Yeah, so I hope this just goes to show that, yeah, it's really, you cannot time, there's no exact time. There are, of course, the other bits where you're looking at around the dates that the price is going up and going down. So any stock that is trading, this is CD is come dividend. That means if you buy, you would be in the books to receive dividends and all that. You'll find that the price is on an upward trajectory. So most of the time, that might not be the best time to buy. You can wait once the books close, then it comes down. But now these are things now we look in detail, and then we just look through the market watch on the platform in itself, and we're able to understand how. So you can't time the market, but there are cycles that you can be able to, I call them riding the wave across the market. So you're doing like momentum investing in the stock market, which is again very important to make sure that when you're investing in stocks, to know which stocks to buy, to know when to buy or sell. You can only be able to refine your expertise by being actively involved. So if you look at some of this, again, maybe your second assignment, look at the price list and just see when was the last time you attended something and you were encouraged to invest in stocks and you said I would, and maybe you didn't. And then now we are here saying, Stanbic has moved. Yeah, those, you can see those margins that are there, opportunities that we have missed. So let's not do this again 3 months, 6 months down the line, and you have not made any move to participate and enjoy some of the benefits that are there when it comes to investing. Take charge. You only get to understand best when you are actually involved within that space. So that is on stocks. For just those the guidance and the support and understanding at your own pace. I will share my contact, and then you can reach out and we can be able to go through I call it the spotlights on stocks investing. And we see to be able to do that, we create your stocks portfolio and we start participating in the market. So on stocks, on bonds, again, common question, when should I buy? Should I really buy? Which ones should I buy? And all that. Again, there's no one answer as such. So I thought, let me share. So these are the two, especially when it comes to government bonds. So bonds can be issued by government or corporates. We've seen corporates last year coming in, ABL, we saw Safaricom. but the most common from government, and governments issue bonds on a monthly basis. So every month there'll either be a bond or 2 bonds or 3 bonds. So when you look at it, what really are you looking at to know, should I buy or should I keep my money and look for the other opportunities? As I said, even for investing, just like budgeting, your investment portfolio needs to start from a values conversation. So, and your values would be, your vision would be for how long? Is it 5? Is it 10? Is it 15 or 20 years? So when you have that duration aspect, then now that is the criteria you use to decide, okay, should I consider it? Yeah, even before you look at it, should I consider it based on that? So this, what I would say is, of late, we've seen the government issuing a lot of long-term bonds. Again, for them, from an institutional perspective, they are trying to just spread out. So the longer the bond, you would find, yes, the higher the return, but then they're not issuing new bonds. They're issuing bonds that had been issued before when the interest rates were not as high. So again, they are able to manage their debt level. So you can see this is a bond that is maturing in 6.6 years, and the rate that is fixed for them to pay is at 12%, right? We have seen rate levels at 17, 18%, and all that. First, would be looking at it from, again, just the returns angle. You want to be able to realize as much return as you can from investing in fixed income. So fixed income works in your favor, but it can also work against you. Because the return is fixed. So if you get in at a high, during a high interest rate cycle, then that means that return that you lock in for that bond will be for that duration. What I mean is, if let's say we had a bond that was being issued for even 10, 15 years in like 2023, 2024, when the rates were high. So that bond would be at around 17, 18%. If I buy that bond at 18%, the government is not going to come and tell me in 2025 or 2026 that, oh, the rates have come down now, so we are going to pay you only 12.5%, because those are the prevailing rates now. It is fixed. So you enjoy that 18% for the duration of that bond. If you come in and buy a bond, like a long-term bond, the same 10, 15 years, and you buy it at 12%, then it is again fixed at that 12%. So you can't also come back and start saying, oh, you know what, they should pay me more because now the rate's at 17%. So now that we know that, then we also need to work on the frequency of us being able to invest. So in as much as it's fixed, it's not something we should just do once. So that is one consideration. The other one is to look into see. So this one, there's withholding tax. This one is tax-free. Yeah, you can see. So again, if you're buying the same bond, if I put 200,000 here and I put 200,000, I put $1 million here and I put $1 million here, I would get more from the infrastructure bond than with this. And I always say, yes, we would aim for more of the infrastructure bond because we pay enough taxes, good enough tax. It's also good to receive something in full that is tax-free from the government. So again, aim for this, in as much as they're not issued as often as we all hope they would. It is good, as we have said before, put money aside, pool money, so that when this opportunity comes, whether it is July 2026 or September 2026, the money is there. You're not starting to look for money to be able to invest. So for the fixed bonds, if you buy any bond that is less than 10 years, the tax is at, the withholding tax is at 15% on the interest, not on the principal amount, on the interest that you earn. If you invest in a bond that is more than 10 years, then the tax, withholding tax, reduces to 10%. And that's why you see these are all bonds. This was a 20-year bond. So these last three words will tell you the duration of the bond. So this one would be, oops. So this one is a 20-year bond. This one's a 20, and this is what, 25-year bond. which was issued in 2021. This was issued in 2019, and this was issued in 2012. Yeah. So you see, because there were more than 10 years, then the withholding tax is at 10%. So that also stays. Minimum, again, is 50,000 with increments of 50,000. So you can't buy 60K, you have to come in and buy 100. Again, more important, pull that money in a fund somewhere. And when you're talking about funds, we are looking at the funds we have. Very key question is one, where, which basically means which fund manager, and then two, how many funds do I need to have when I'm working on my saving strategy. For me, my recommendation is always try and keep it to at least 3 funds. Yeah, 3 funds. One, of course, is your emergency fund, where you're looking my values, my priorities. Those are the expenses that are able to help me with my priorities. And then now you work out and say, excuse me, then you work out and say, I would like to have maybe 3 months or 6 months of that amount sitting somewhere which I can easily access. But in the meantime, it is earning something. Yeah. So now you choose which fund you would want to put your money for that. Then you have, so that is your emergency fund. And then you have your investing fund. This is the one I was talking about, where, we are working and saying, okay, fine, I want to be able to just have money, earning interest, but ready enough if there's an investment opportunity that I want to take up and I see it's going to help me realize that vision that I have. Then it is there. You can easily move it from that investing fund into the investment opportunity. And then you have your opportunity fund, sinking fund. This is for, yes, we want to do a family holiday. Yes, I want my own funds to, I'm turning 40, I need to do a trip. Let me start saving for it, save for it now and all that stuff. So, or I have these annual lump sum expenses, car insurance, health insurance, life insurance, that I want to go to put money so that I'm in the middle of April, I'm not starting to figure out where I'm going to get money to pay for those things. It's easier when you're able to do it slowly. So there's the considerations when it comes to, especially which fund manager, is always on 2. You can look at it from 2 ways. One, and this is again very personal. So one, you can look at it from a market share perspective, where you'd say I would feel most comfortable putting my money with a fund manager who has a lot in terms of the assets that they're managing, which kind of like is a portrayal of the trust that people and institutions have with that fund manager. That's why they are managing that much money. So if that is now very important for you, then you'd be looking at it from that angle and saying, okay, then I'm likely to put my money at Sanlam, I'm likely to put my money at CIC, because now those are the ones who have, in terms of market share, those are the ones who have like the highest market share. Then there's one who would have that conversation with themselves, or, when you're sitting down with me, would be looking and saying, okay, especially for like your investing fund and your sinking fund, you want to put your money where when that money is there, it's earning, it's working, and it's it's working faster than most, and it's looking at it from the returns perspective. So yes, I will look at all the considerations. Is the fund registered and licensed and regulated by the Capital Markets Authority? Yes, it is. Okay, so then that means there's oversight over where they are putting this money that I'm putting there. So I'm likely to go with a fund that is going to give me good returns. So then now you start looking at it from a returns angle. So if that's the case, then if you're looking for a normal money market fund, you are likely to go with Etika. You will consider NABO. I will not talk about Cyton for me. you will look at 𝐻𝐿, you are going to look at 𝐿ofty-Coburn, look at Jubilee, you look at 𝐘𝐨, you look at Madison. So, you know, those now become part of the considerations. And these are now the discussions when we are doing the clarity session, we're also able to have. And again, I always say, for me, it's not just theory, it's all action. We choose, we open. We don't talk, okay, we should open with this one, we should do this. We agree who we are going to go with. Okay, we'll do, I'll put my money with 𝐡𝐚𝐭. I will share with you the link to be able to start off that conversation. I've had clients who've called me and they said, yeah, when we spoke, you said they're at Westlands. Can I go to their offices? I'm like, yes, please, sure. I'll call them there and tell them I have a client who's coming, you know, say hi and guide her through the account opening process. Again, it is your money, so whatever makes you comfortable, you know, let's have that discussion, and now we can be able to figure out where to put your money. If you want to put your money with 𝐻𝐿, we look at what their offerings are, and then we choose the best fund. So you'll realize for most of this fund, they only don't have one fund. Again, you know, it's to decide if I'm receiving income in dollars, instead of converting to Kenya shillings I can be able to just retain it in dollars and open a dollar account. So again, now we have that conversation. We look and see, okay, fine. If it is in dollars, then I would be looking at, okay, let me consider NABO Capital. Let me consider either 𝐡𝐚𝐭, let me consider Sanlam. And for those three, you know, we look at it, we agree why we are picking those ones. You know, again, fully digital. I share the link with you. You are able to open, we follow up. From my end, I follow up with the team at the respective fund managers and make sure the account is opened, set. You know, we agree on the frequency of savings. You know, we work through what we had talked about, the savings rate, and we're able to do that. If it's in Kenya shillings right now, the consideration is either putting your money in a money market fund or a fixed income fund. And we've seen the fixed income fund, the returns are slightly better than that. So again, this is the discussion we have. So why, you know, 𝐡𝐚𝐭 here, if I put my shillings in 𝐡𝐚𝐭 and in the MMF, I'm getting 11.8, but if I put it in the fixed income fund, I'm able to get 13.2. And I would explain, you know, the difference between how they're able to get this return, how, you know, the bond prices are inversely related to the interest rates, and why now, when you're looking at most fixed income funds for the most fund managers, they're able to return better. And that is it. So when it comes to the funds, it is which fund manager. I've said again, it's a discussion with all this. From our end, we work with most of the fund managers. We work with 𝐡𝐚𝐭, we work with NABO, we work with 𝐻𝐿, we work with nWealth, we work with 𝐿ofty-Coburn, we work with Jubilee, we work with 𝐘𝐨, we work with Sanlam, we work with CIC, we work with Britam, we work with ICA. Yeah, it's quite a list. So again, what we pride ourselves at Finance for Families is at the heart of it. For us, the client is at the center of it. So we approach it from your angle and not really from the fund managers. So as I said, if you are more on, I would be more comfortable with a fund manager that is my interest indicator is the market share, then we will say, okay, fine, we will go with the Sanlam Alliance and take you through that process. If you're okay with the returns, then now we look at the returns table and we're able to have that discussion as well on the normal money market funds. The special funds, these are the special ones now. So the normal money market funds normally just invest locally, but the special funds now invest in the global markets. So questions again would be, which special fund do I put my money in? And then are the returns guaranteed? Are they legit? Because sometimes you're seeing 11% there and then 20, you know, like you can look here for 𝐻𝐿. If you look at the 𝐻𝐿, my friends at 𝐻𝐿, where they're here. For the normal money market fund, we are getting 11%. But if you come and look at the special fund, you know, yeah, we are getting some returns. So when you see that, of course, it's good to ask those questions. And I like for most fund managers, like especially for the special funds, Mansa X, AVOCAP, KUZA, 𝐻K is pretty new, Oak Fund, they do take their time to be able to just come out and share and what the fund is doing, in the investments they've made, discuss the returns with you, the global environment with you as well, with all of us as investors, so that at least we get to understand how it is, how they are able to get these returns. So very key. Where do I want to invest? Of course, those are now discussions we have. We can look at the minimum investments. So if maybe you're just ready to put 100,000, then they'll be the ones we can make considerations. If you want to go to just put some money aside so that you can get to the minimums that they require, then you can be able to do that. But very key is to understand the lock-in period, which is any money that you put there. For me, I recommend let it be money that can be there for 1 year so that we can fully realize those returns, the per annum returns. Key again is also on the fees. You realize for the normal money market funds, there's only the management fees, which would be about 2%. But for the special funds, because now they have people sitting and looking at the global markets to be able to get these returns, they also have what is called a performance fee. So, and they would put like a hurdle rate. So they'll say, for this fund, we are giving ourselves a target of 25%. If we get 25%, if we get 30%, that 5% extra on top of our target, we are going to charge a performance fee. So instead of you getting 100% of that, the extra 5% above the target, you would be getting 90% of it. So they would shave off 10% and like that. So these are fees, because remember again, fees eat into your returns. So it's always good to look and see these fees, and then we look at it from like a net return perspective. Again, if you want to have a conversation around market share, then it is just good to be able to look. This is a report that is normally shared by the Capital Markets Authority. And you're able now to see how they rank in terms of how much money they are managing for people out here. But yes, I would say again, for us at Finance for Families, we work with all these fund managers. We work with the Mansa team at Standard Investment Bank. We work with the Oak Fund team at Faida Investment Bank. We work with the KUZA team. We work with AVOCAP team, and we also work with Etica. So for us, of great importance is you, and we approach it from you. We lay it all, and then now together we make that decision, and then we are able to do the application for that. Yeah, so that is on special funds, just on the funds. And yeah, so when I looked at in all those investment options, I said, let me share, just based on my experience out here, like the key things I feel like we need to be able to look at when we are thinking about our portfolio growth. Again, our portfolio growth is what is going to help us harness the power that is within this money that we are investing. And one of the things I would say I would want to highlight when you're thinking is, and I think I've mentioned this when you're talking especially about the savings rate and everything, the return you keep matters more than the return you earn when you are talking about the management fees, performance fees, and all that. It's good to look at it from that point, where what is my net return? Yeah, and not just, I can look at that, you can get a fund that will pay you 30-35%, but they have a performance fee of 15%. So if they surpass that target, in as much as yes, you have earned more, but again, you are also leaving a lot more on the table for them in the form of the fees that they are charging. So again, those are now like the numbers that we put together just to help you see that picture and not just look at it from that returns perspective. So it is just getting to a point where we're asking ourselves, how much money, how much of that return am I actually keeping when I think about one, those fees, when I think about the tax, because again, all these funds, the interest is taxed at 15% per annum, and then there's also inflation. So we really work at understanding the real return. So that is one which I feel is very key. Sometimes we just blindly look at the return and we think that is enough. Another insight is really, for me, is for us to just be aware that our behavior is the biggest investment risk. Not really the market. You know, when we're talking about investing in stocks, and I was sharing, for most people who have, like, I would say, a negative story about investments, if you just go back to the beginning, you'll realize, you know, they just started investing and they didn't really put in enough time to understand how the market works before they put their money there. So investing time is very, very important. And sometimes we find like most of the decisions we are making are very reactive, they're very emotional, and they cost us a lot. Meanwhile, if we had, you know, as we said, emotional intelligence, just taken aback and understood, how do I react when I'm emotional? And then now, what can I be able to do to reduce my, you know, my that reactiveness? You know, is it getting more information? Is it doing a check-in session with Linda just to understand better, so I can calm down and not panic too much about what is happening, and get to understand that, you know, this is a very short-term thing, but my decision could be could have very long-term effects. So let me just ride this short-term wave, but, you know, sit through it and come out victorious on the other end. The other one, so yeah, so again, let's remember that our behavior is the biggest investment risk. We can think about very many, but that one is the first one we have to learn how to manage. Mostly, you know, mindsets and emotional intelligence would help us around that. The other gem for me is on volatility. And volatility, to be honest, is really the price that we pay for admission into something that is of a higher risk. So if for someone, and I've seen people who've put their money in bonds, and bonds, like, the risk level is very low. So you get money sent into your bank account on a Monday, you know, you're happy, and then you have a session with me and I tell you that money needs to be reinvested. And we can get to a point where now we say, okay, fine, do the stock session, and now we'll start putting the coupon interest that we are earning into the stock market, because then now we are looking for growth, you know, slightly better returns. Yes, slightly higher risk, but we are doing that because we already have a cushion of investments that are of lower risk. So as we take that interest and move it into the stock market, we are going to now start experiencing volatility more. And volatility then becomes the price that we are paying for admission into something that is of higher risk. It does not necessarily mean that, you know, there's something wrong with the stock market, or, you know, there's something wrong with that company. So unless there's you know, fundamental reasons where now we'll sit and say, hey, okay, no, now we need to exit that company because you know, the management are having issue, or their strategy is not very clear, and all that. But most of the time, volatility is really just a sign that now you have moved into something that is slightly more risky. And of course, the higher the risk, the higher the return. Then last gem is fees compounding against you. So again, it's just getting to understand, as I've said, let's not just look at the return, that 30%, and get excited, that 50% and get excited. It's also looking to see how much are we paying, because if you do the math on that 2% that you are paying, and you say, this is money that I keep here for like 5 years, 10 years, you will see that 2%, that's 10% or 20% performance fees, actually a lot of money. So again, those are things that you put in place, and then you just make sure that then how do we mitigate against that? How do we make sure that we're able to sort of like recover through in the portfolio by investing in other less riskier investments, or just in ways of being able to just caution against that by putting money into, yes, asset classes that the charges are not as high, but the returns, are competitive enough. Yeah. So those would be my key gems when it comes to investing. When it comes to retirement planning, and this is now on the generational wealth conversation, where I always say we find couples are never really planning retirement together, and it actually shows. It's very sad. And for those of us out here who are in committed relationships and or married and all that stuff, and this is someone you are working long term with, then you also need to have those conversations that, especially when it comes to retirement, because you realize, as I said in the beginning, some of these things, the decisions we make, they don't just affect you, they end up affecting the people that surround you. So it's good to have those conversations. We've seen situations where maybe the person who was in charge of finances passes on, and then you are left there. You have no understanding, one, of even where the assets, which assets you have as a family, where to even start, because you are very passive in that conversation. So my biggest gem for this, especially for clients who come and we're doing retirement planning and they are married or in a relationship, I always say, please make sure you have that conversation. Their retirement plan will really affect your retirement life. Yeah, if we really think about it. So let's have those deep conversations so that you can be able to feel, what we call the survivor gap. When you lose one, you lose a partner, and then now you are shouldering everything alone. Then the other one is retiring too late. Sometimes when you're working out your retirement figure, then you say, man, I might need to work up until I'm 70 so that I can be able to get maybe that amount of money that I want. But for me, I want to do it. Retirement really is about you taking a step back for you, yeah, to be able to enjoy life. So if the honest conversation should really be when would be that ideal moment for me now to just start slowing down? It doesn't have to be 70. You can imagine, even if you have 30, 40 million and you are 80, you work till 80, 85, how are you going to enjoy that money? And if we had maybe even 5 less or so, but we are younger, we are healthier, we are able to do now the things that we've always wanted to do. So please, let's not think of it as, I have to be 65, I have to be 75 for me now to stop. It's when can I be able to start doing the things that I want to do, so that you don't get to that point where the money is there, but you are not, you're not there fully. Maybe now old age is catching up, you're getting sick, so you're not even able to enjoy that fund, that retirement fund, as you had envisioned to be able. So those are conversations that, again, you have to have as you're working on your retirement. Yeah. Then on generational wealth, this is where we're thinking about legacy planning. How do we pass it on from the great-grandmother to the grandmother to the mother, to the child, and everything. So yeah, of course, we've had discussions on the legalities of it. Let's just make sure that we put instructions aside, that will that just documents and talks about what you want done if you are not there. Let's be able to just transfer this wealth in an organized and legal manner through setting up a trust. Again, those are conversations. In March, I was I co-hosted an event where we were talking about just wealth building, and we looked at it from an angle of growth, just like today, an angle of growth and an angle of protection. And we had the ICA team and Diana from Anderson just coming and shedding more light on that protection aspect. But for me, I think one way, as again I said, I'm just going to share with this one. For me, it was just to share gems that I feel like these are other things we can think about that, most of the times we won't find in the general notes out here. There is something that is called a letter of wishes. So remember, when you put down a will is very structured. It's a legal document. You talk about, okay, I have these assets, so this is how I'd want it distributed, in that legal term, so that it can make it foolproof, that, it's not contested and all that. But then you actually do have an option of writing, I would say, like a love letter from the other side, where you're able now to just privately document down and just say, write a letter explaining to, the loved ones that you have left behind. So I made these decisions, as per the will, and this is why I made. You speak to the children about, what it is you'd want for them. Whoever is executing your will is able to use that as a guide to just understand the family dynamics that are there, that sometimes, when you are drafting that will, you can't be able to see. So this is something very private and very emotional that you can be able to pen down and now have it as part of your, I would say, your will file, where when the will now will be read out, it can also be shared. I feel like sometimes when we see all these issues going on out here, it's because we've not had that. People are handling so much emotionally, trying to understand why you did this, why you said that, why did you leave this to whoever and not me, and yet I'm the one who took care of you when you're old, and all that stuff. The other one is, again, just to be able to cultivate a shared family philosophy. Wealth is not really just about the money, the piece of land, the flats, all those things that you're passing. What no one can take away from your family members, your loved ones, is that shared philosophy. What is it? What are our values around money? What are our values around work? How do we view responsibility? How do we work around service, servant leadership and all that stuff? These are things that get passed on. I've seen my mother doing this, appreciated it. Now I'm a mother, I'm instilling the same in my children. I'm hoping, and I know they will see the value of it and instill the same in my grandchildren, the great-grandchildren. So then that makes it way beyond money and all that stuff. So yeah, I think from me, that is it. I hope I've been able to share more gems than what we've commonly had out here, because that was my goal for today's session. And yeah, with that, I just want to say thank you, and I hope I have challenged you enough to want to take the power reins when it comes to your finances, and through this session and through the actions that you're going to take, because again, we've said it's not just the session, we'll try and make sure we action most of these things. It'll be very good. One, you get to grow your knowledge, but it also grows your confidence from the actions that you take up. So again, it's just to ask for you to be able to share your reviews with us about this webinar, about what we have shared today, what really stood out for you. That one point you said, this one touched a nerve and I'm going to act on it. Or yeah, I'm so happy I attended because now I got to learn about it. So just share with us your reviews on our socials, whether on Instagram, on LinkedIn, on WhatsApp, and on TikTok as well. If you have any questions you'd want to ask, sometimes it's very personal, you want to DM, so please feel free. You can email us at hello@financeforfamilies.com, drop us a WhatsApp. We'll be able now to reach back and and answer and guide accordingly. And that, so we hope you will stay connected. If you're not already following me, please do on my socials, on Instagram, on LinkedIn, on TikTok. It's at linda.makatiani. And again, I'm looking forward to having those conversations, one-on-one conversations with each and every one of you, so that we can be able to sit down and map something that is truly tailored to you as it is. So with that, thank you. I will take any questions. I'll just go to the site and see if there's one. So Indy asks, how can we access this recording? So we'll share it on our YouTube channel. I think at the beginning I had shared the link on the chats. I had shared the link to our YouTube channel. So we'll have it posted there, and then even after this, we'll do an email and share the link to that, but that should be out tomorrow morning as well on our social media channels from IG, LinkedIn, and TikTok. You'll be able to see. Yeah. So yes, thank you, Yvonne. Marianne asks, does it mean if the performance fee column is empty, then there is no charges for that? And what is the difference between fixed income fund and special fund? Yes, so there are special funds that don't charge a performance fee. If I can just quickly go back to that slide, you would see, I know my friends at Oak Fund don't. So, but you'd see their management fee is slightly higher, but they do not charge a performance fee. So when you see that, then that means there's no performance fee. Etika normally for their normal money market funds, the fee is 2%, but then for the special fund, it's 5%. So not all special funds charge a performance fee, but you'd notice that for most of them, the fund is the management fee is higher. So for Avocap, their management fee is similar to their normal money market funds, but then now their performance fee is slightly higher. So that, I hope that answers the first question. And then the difference between the fixed income fund and the special fund. So the fixed income fund, any money that is pulled into the fixed income fund invests in fixed income securities, which are bonds. The special funds will invest, yes, in bonds, in stocks, and they will do that not just in the local market, but they'll also be able to invest in the global markets. And that is why now, again, you see the fixed income funds can get returns of like 13%, 14% for some. But for the special funds, now the return goes higher to, we are looking at 18%, 20%, and all that. So the special funds, they invest as well in the global markets, into stocks and bonds out there in the global markets, and not just here locally in Kenya. So I'm interested, Winnie asks, I'm interested in knowing which top 5 money market funds and fixed deposit funds have the lowest management fees. For most of them, the management fee is normally 2%. I will see. I think I can be able to compile that, just especially for the ones who we work with, I can be able to give. But for most fund managers, their management fees at 2%. I'm trying to think if there's any who's at 1.5%. So most of the time it's between 1.5 and 2% for that. Yeah. Yes, thank you so much, Yvonne, for as well being here. And I think any other questions before we call it an evening? Yeah, but again, yes, so our thank you, Rachel. Thank you, Marianne. Yeah, so those are my contacts. As I said, I'm looking forward to engaging further. I know sometimes maybe later on when you listen to the recording, you'd be like, oh yeah, but there I should have asked this. Feel free to reach out, and yes, we can be able now to just have that conversation on the side as well. But thank you all so much for investing time. Again, I'm always saying investing time is very important even before we start investing the funds. So thank you for being intentional and being part of today's conversations. let's keep talking through the socials, whether it's through the social media platforms, through WhatsApp, give us a call. And yeah, have a nice evening. Thank you so much.